Yeah, I am back. I'm back, as we said, with something a little bit different this time. I'm not doing that everything stock chart segment. I'm actually really looking forward to talking to you guys about what I do outside of my role here at Stock Charts. I am an investor. I've been investing for quite a while, so I'm excited to share some stuff with you guys today. I wanted to see if anyone caught my little joke here with the title. 10 for 25. That was my way of referencing the 10 and 10 to 1 segment that you guys do. I thought you were doing that. I'm going to copy you guys. I'm going to do 10 for 25.
Yeah, I thought that might be what that was.
All right, you caught me because I had no idea what it was.
Oh, I knew that would sneak past you, Bully. No, anyways, I'm sort of covering today 10 essential lessons, rules, and strategies from what I'm calling a lifetime of investing. And Tom was joking with me a little bit before the presentation, saying a lifetime of investing, you're only 25. But as I'm going to talk about here in a second, I really started learning about the financial markets and actually looking at charts and starting to buy stocks when I was 10 years old. I know it sounds a little crazy, but it's true. Since then, I've gone on to do a couple things. In addition to being the business manager here at Stock Charts, I've actually written a couple books now. My latest book was Trading for Dummies, which came out last year. But I actually started writing my first investment book in college, and that came out in 2016. It's called Tensile Trading, the 10 Essential Stages of Stock Market Mastery. So there's a little fun tie-in there with the title as well, and the title of my book. Since then, I've gone on to co-found this little investment education company called Stock Market Mastery that I'm doing alongside my father, and through that we teach investment courses together. So it's been a fun project to work on. Anyways, I wanted to give you this background because what I'm trying to say here is that I'm not just the stock charts guy. I'm not the guy who helps put together the charts and work on the the technology behind the scenes. I actually use all of the features on the site. The features that we develop and the things that I sort of, the opinions and ideas that I come up with for features on the site and everything, they're things that I actually go on to use in my own investing. I am trading actively, managing my own money. So that's the point of this. I'm kind of getting the opportunity here to step outside of the stock charts role and talk to you as an investor. So before I really begin, we are going to absolutely fly through today's presentation. I got way too excited about coming on and joining you for this thing. So I got a lot of slides to get through here, but I think we're going to have some fun. So anyways, like I said, my story begins at a pretty young age. I was 10 years old when I started learning about the financial markets. And my story begins with a pink highlighter. It's kind of weird, but bear with me here for a second. As I mentioned, I started learning alongside my father. My father actually has been investing actively, managing his own money for 30 years now, something like that. I think he might have actually just crossed the 30-year mark. So he was teaching investment classes when I was a young kid. And I always wondered, what's dad do for a living? I knew that he was a stock trader. I didn't really know what that meant. And I knew that he was teaching these courses. So at the age of 10, as a demonstration to his class, he actually brought me up on stage in front of 100 people that were taking his courses each semester. And he gave me a pink highlighter, and he put up a chart on the overhead projector. Back then it was an overhead projector. And he said, Grayson, draw trend lines. So at the age of 10, what he taught me to do was draw trend lines with a big pink highlighter on charts. So I had things just like this. He'd put up a chart on Microsoft and he'd say, Grayson, take this big pink highlighter, draw some trend lines across the chart. And so at the age of 10, again, I was doing this very simple investment analysis, financial analysis, investment research, really. And I was making relatively informed decisions about different stocks. What the class would do is they would throw up all these different stocks on the overhead projector, and I would draw trend lines on all of them. And so you'd have these people that were, in their 50s, and they're arguing about, is GE a good stock to buy? And I would come up there and I would say, no, it's going down. Simple. And I was 10 years old. So the important thing that I want to mention here, and the reason that I'm pointing this out, is because my investing started from a very, very simple point. I learned one of the most basic, fundamental aspects of technical analysis that everyone starts with, and that's just drawing trend, analyzing trend. And that has invaded the rest of my investing philosophy and the strategies that I use those really, really simple lessons that actually allowed me to buy stocks when I was 10, 11, 12 years old, I still take those to heart. I still use those on a daily basis. And I grew up playing sports, and all my coaches would always say, keep things simple. Keep it simple, stupid was the KISS methodology. I take that to heart in my investing. I try to keep things as simple as possible. I don't believe that the most complex system actually yields any tangible benefit. I think that simple systems executed perfectly work. So that's kind of what I'm going to share with you today is how I try to keep it simple. So I've got 10 lessons to share with you, again, from a lifetime of investing. I've been actively investing on my own since I was 18 years old. I started trading my own account when I was 18. But throughout middle school and high school, I was actually investing alongside my father. So it is really kind of 15 years in the market. These are the 10 lessons, 10 most crucial lessons that I can pull. First and foremost, investing is a business. Woodworking is a hobby, investing is a business. It's your responsibility as an investor, as someone who's managing their own money, it's your responsibility to treat your investing as a business. I sort of like to say, treat yourself like the business that you would like to buy. I want that to stick with you. Treat your investing like a business. Now, one thing to note here too is that I'm talking to you as an individual investor. I'm managing my own money. I'm trading my own account. So what I'm trying to do on a daily basis, on a weekly basis, monthly basis, is take my investing as seriously as I can, treat it like a business, and sort of go from there. Implement strategies and routines and practices that any good business would use to operate. Lesson 2, buying is stage 7. Now this is in quotes here because this is actually, it comes directly from my book, Tensile Trading. Investing is about a lot more than just picking stocks. I see these people all the time that say, okay, I want to start managing my own money. I'm going to go buy some stocks and I'll figure out the rest later. I'm just going to go buy a couple stocks and see what happens. And then I'll try to put all the other foundational pieces in place later on. You're going about it the wrong way. What I'm going to show you in just a second is this kind of roadmap that we built that really defines our book, the 10 stages of stock market mastery. And the point there is that buying is actually stage 7 in our 10-stage roadmap. You need the foundations in place to set you up for successful trading. It's not about just diving in head first and saying, I'm gonna go pick a bunch of stocks and see what happens. You need to design and follow a system. And I'm gonna harp on this a little bit more as we continue on. You need to design and follow a system, not just start randomly throwing darts. So here's that roadmap that I mentioned. And as you can see, buying up here is stage 7. There are all these pieces in place that you have to go through. One of the big ones that we're going to talk about in just a minute is the investor self, really understanding your own psychology. But there are all these pieces that you have to go through, these stages that you have to go through before you actually start buying stocks. I firmly believe that. Buying is stage 7. So I mentioned this just a second ago. Lesson 3, have a system and write it down. This is arguably the biggest lesson of them all. If you walk away from one thing today, walk away with this. Embrace an investment approach that is appropriate for you. I see these people all the time. I talk to a lot of investment groups and seminars around the country and things like that, and through stock charts as well, get the opportunity to talk to a lot of investors, whether they're new or they've been investing for a long time. A lot of people jump into the markets and they say, I'm going to start trading options. And then I say, okay, well, back up for a second here. Why do you want to start trading options? And they say, well, I read this article in Forbes about this guy and he made a ton of money trading options. So I think I need to trade options. That's the wrong reason to get into trading options. If trading options is the wrong thing for you, it doesn't matter that it was the right thing for someone else. It's the wrong thing for you. What you need to find is an investment approach that is tailored to fit your specific needs, your interests, your time frames, your objectives, something that's tailored to fit the true you, the realities of your life, the realities of your personality. The biggest component of that is understanding the true you. I actually studied psychology in college in addition to economics. And so I had this fascinating opportunity to learn about cognitive psychology, thinking, judgment, decision-making, how our brains actually work and process information. And it's incredible. We're going to talk about this a little bit later in the presentation. It's incredible how much your brain actually works against you, specifically as an investor. We'll come back to that. But understanding the true you and using that knowledge to build an investment system that's truly appropriate for you is massively important. And again, I put write it down up at the top. Write it down. I talk to all these people that say, yeah, I have a system. I don't really know what it is. I kind of forget it occasionally because it changes. It was different last week than it is this week, but it's a system. Yeah, no, it's a great system. It really works. I like to say that you find your edge in the market by crafting your system. You can build a system that will give you an edge in the market, and you find that edge by crafting your system. You sharpen that edge by fine-tuning and tailoring that system to better fit you over time. It can evolve. It doesn't have to be, totally decided from day one, from square one. You can evolve your system over time as you sort of learn more about yourself. You get deeper into the markets. You can fine-tune and tailor that system to sharpen your edge. But you still need a system, and you need to document. What is a system? A system is intentional, it's describable, it's repeatable, and again, it's appropriate. Now, walking through all these really quickly, it's there for a reason. It's intentional. It's not someone else's system. It's your system. It's describable. You can write it down. If you can't write down your system, if you can't actually put it into words, write it down on a piece of paper and tack it up on your wall, your system is broken. It's not describable. It's repeatable. And a great benefit of technical analysis, I believe as firmly as I can, technical analysis allows you to build a system that is repeatable. It allows you to use the same indicators over and over and over and learn about them and build a system that can be repeated in the future. And again, it's appropriate for you. It makes sense for who you are. Now, my system, diving into it really quickly, as an investor, everything starts with appropriate climate. If the market's crashing, if we're looking at 2008, market's crashing, I'm not buying. That's fine. If the market's going down, I believe that a rising tide lifts all boats. A sinking tide sinks all boats, whatever the opposite of that is. Not a sinking tide. That was probably the wrong way to put that. But appropriate climate is the first thing. Strong technicals. I am a technician. I work here at Stock Charts. So technicals obviously play a big role in my investing strategy. Shorter term potential. I generally judge shorter term potential based on technicals. I'm looking for companies that are going to appreciate. They got new products coming to market. They got good things happening. And over 6 to 12 months, whatever it is, that company's going to grow. I look back in time, though, and I look at that company's decision-making history. I like to find companies that have a strong track record of great decision-making. A good example of that is a company like Nike, maybe. Nike's been making great decisions about its products and how to grow and markets that it's going to enter and things that it's going to take on for a very long time. That gives me a lot of faith in trading or investing in Nike. And kind of building off of that, a longer-term belief. So personally, there are segments of the market that I ignore just because I don't have a longer-term belief in that segment or in that company, even if in the short term, they're doing really great. A good example maybe is something like cigarette companies. So there are times when cigarette companies start doing fantastic things. They're growing, great technical patterns developing on the chart. But over a longer term, I'm not so sure that cigarette companies are something that's going to keep growing. I don't think the long-term trend is in their favor. And so that's something that I actually steer clear of because I don't have that longer-term belief in those types of companies. As a technician, this is the interesting thing about today's presentation, because obviously we're on Stock Charts here, Stock Charts TV. My technical strategy really breaks down into 4 components: trend, relative strength, money flow, and momentum. Now, I've put up basically all the indicators that I use on my chart. I look at the same chart for every stock. I've got specific charts for equities, for stocks, for ETFs, for mutual funds. But talking about specifically the charts that I look at for stocks, I use a 20-period exponential moving average. I use a 50-period, 100-period, 200-period, and a 425-period simple moving average. Those are the moving averages that I use on my chart. Those are the moving averages that I have found help me determine trend. And then again, I'm looking at just sort of price developments. I'm annotating charts, drawing trend lines, and looking at what's happening on those charts. I employ relative strength strategies, not before trend, but they are a huge, huge component of what I do. And I'm going to dive in just a second here to something that I call the Fantastic Four, which is kind of explains the relative strength strategy that I use. In addition to that, I use scooters. Scooters, the stock chart's technical rank. Greg Schnell does a fantastic job talking about scooters, explaining how to use them. The research that he's done on scooters is fantastic. Follow Greg, learn about scooters. They're an amazing relative strength tool. I look at money flow, primarily analyzing volume, Chaikin money flow, and on-balance volume. It's kind of a combination of those. Specifically on shorter term charts, actually. When I go to place a trade, I'm looking at 20-day, 1-minute charts and looking specifically, very specifically, at on-balance volume and how that's developing over a shorter term period. And finally, momentum. I use the PPO, sort of a modified version of the MACD, which is one of the most popular indicators out there, and RSI. So again, this presentation is kind of focused more on these 10 lessons, so I'm not diving into the technicals as specifically as I could. But I did want to put this up there and show you that my technical system breaks down into trend, relative strength, money flow, and momentum. I've got a very specific set of indicators that I use and tools that I use, and I use them repeatedly and consistently, always. Now, one of the most important things for me is something that I call the Fantastic Four. Hopefully I don't get sued for using that name here. We'll see. But under stock charts in the indicators panel, you can select price performance, and you can add these 4 blocks to your chart. Now, I've put up here the $ symbol to VTI, $ sector to VTI. Those are what you input into the price performance input. But explaining each of these, what I'm looking for from a relative strength perspective is the symbol versus the market. VTI is Vanguard Total Index. It represents the entire stock market. So that first bullet is the stock that I'm looking at versus the entire market. How is this stock performing relative to the entire market? If the stock is underperforming the market, I'm not going to buy it. If the stock is outperforming the market, I'm interested. That's what I'm looking for, is outperformance. Next is that stock belongs to a sector. So how is that stock sector performing relative to the market? I want to own a stock that's in a sector that's leading the market. Tom was talking earlier about technology and cyclicals. I love technology and cyclicals right now, and I want to own stocks that are in those sectors because they're driving the market higher. So $ sector to VTI allows me to see how is this stock sector performing relative to the market. Now, drilling down one level into that is that stock's industry group. Within its sector, there's an industry group that it belongs to, and I want to own an industry group that's leading a sector that's leading the market. So I have $ industry to $ sector, and I get to chart that. Lastly, I have the stock, the symbol, versus its industry group. So work back up from the bottom. If you align all of these things and you sort of put them all, you've got, I'm going to show a chart here in just a second. You've got strong trends in all 4 of these little mini panels. You've got a stock that's outperforming its industry group, which is outperforming its sector, which is outperforming the market. That is 4 things lined up from a relative strength perspective that put the wins at your back, the wins of probability at your back, and the probability of that stock continuing to lead, continuing to climb and appreciate is dramatically improved. So that's what I'm looking for. On a chart, it looks something like this. I pulled up Netflix. We were talking about Netflix earlier. I've got these 4 panels on my chart. This is Netflix versus the stock market, represented by Vanguard Total Index, VTI. That's outperformance. Okay, so Netflix is outperforming the market. Now, Netflix belongs to the consumer discretionary sector. Again, another uptrend. So that sector is outperforming the market. Next up, you have its industry group, which again is outperforming its sector. And you have Netflix outperforming its industry group. All 4 of these lines are pointing up. You got a strong trend. You've got a strong trending stock. That's the stuff that I look for. Now, we're going to show this in just a minute. I loved a quote from Arthur the other day in a blog that he did. Expect trends to continue, not reverse. That really kind of defines my investing strategy. So we'll get into that a little bit more. Now we're going to really start to fly here. Lesson 4 is the investor self. It's your job to foster a keen and ongoing, that's an important point, understanding of what I call your investor self. The idea here is that successful investors know themselves. They know their strengths, they know their weaknesses, they know their advantages that they have, they know what gives them an edge in the market, they know their shortcomings, and they're not scared to acknowledge those things. They're brutally honest with themselves, and they use that self-awareness to their advantage. If they're not good at something, they understand how to work around that. They address it, they work around it. If they are good at something, they employ that in their investing strategy. They make use of that. It's your job to foster a keen and ongoing understanding of your investor self. Really get to know yourself. Now, I firmly believe this emotional control in investing in the markets is half the battle. I'm putting up this graphic here from our book that just goes over, this is a classic Wyckoff graphic actually, goes over all the market stages. And for each one, we've got these little emotions. These are the things that you're feeling as the market goes through its cycles: optimism, excitement, euphoria, anxiety, desperation, panic. You need to maintain your emotional control throughout all of these cycles. And if you look at the world's best traders, they're people that can sort of stay flat throughout all of this. They don't get horribly panicked and start to think about jumping off a cliff just because the market's crashing. They take action, they move forward with that knowledge, and they address their own emotions.
Hey, Grayson.
Yep.
You know, the one person that comes to mind when I was looking at that, as far as the emotions go?
Who?
Think about CNBC and who they brought on, to talk to during bear markets.
Yeah.
It's Warren Buffett.
Yeah.
I think Warren, throughout, the stock market can be falling apart, and Warren Buffett comes on and he's kind of that reassuring guy that says, this is a great opportunity, one of the greatest opportunities of our lifetime. I remember seeing that on CNBC back in 2009.
Absolutely. He's a picture of emotional control.
Yep.
And it's, I've always found it really interesting that if you read about Warren Buffett, he spends most of his day, I don't think he has a computer in his office. He spends most of his day, about 6 hours, reading, just taking in information, thinking. He's not on there selling everything in a panic because he sees, one candle on the chart and he gets scared. He is managing his own emotions. And that's what you need to succeed in the markets.
Can I ask you one question? Because you've gone far enough into this where I think maybe
Sure.
It's an appropriate question.
Yeah.
You disregard diversification?
Do I disregard diversification?
Yeah, you said you really like technology, you really like consumer discretionary, so obviously you're going to follow those trends.
Yeah.
Do you diversify into other areas just in case things go wrong, or
I do.
Trends? Okay.
And that's unfortunately, I'm pressed for time, so I couldn't cover that as thoroughly as I'd like to, but I have separate portfolios. That's actually an important thing to understand. I've got longer term, sort of what I call core portfolios that are, whether they're retirement accounts or they're just other investment accounts that I've intentionally made long term. Those are my core positions. They're well diversified. They're in stable things. I'm not looking at the charts on a daily basis. I'm not worrying about the candles. And then I've got a trading portfolio that I'm more actively managing, where I'm, kind of aggressively moving into sectors of the market that are leading. So I do sort of maintain this high level of diversification, but it's in these other sort of more long-term, what I call core portfolios. And then my trading portfolio, which is where I'm employing a lot of these strategies that I'm talking about today, that's kind of what I call the explore portion of my total portfolio. But it's a totally separate account, actually. I literally have different investment accounts for the two. I've got core portfolios that are over there, and I've got the explore portfolio that is totally separate that I'm actively managing. So I don't disregard, Tom, diversification. I do maintain a fairly high level of diversification. I'm looking at correlation values to pick those things. But it's kind of a different strategy, and it's more of a little bit more of a set it and forget it type of thing in a totally separate portfolio.
Okay.
So hopefully that answers it. Who knows? Maybe I'll come back on here and do a whole presentation about that. Give me a couple months though.
Sounds good.
Anyways, I'm gonna fly through here, keep going a little bit. Cognitive biases, we're talking about emotional control. Cognitive biases are these innate tendencies of the human mind to think, judge, and behave in irrational ways, generally that violate sensible logic, sound reason, or good judgment. So again, I mentioned this, I studied psychology in college. I took a class, my favorite class in college was this class called Thinking, Judgment, and Decision Making. And we learned about all the ways that your brain completely tricks you. It does the wrong thing constantly. And when you apply those lessons to investing, the results are profound. You've got all of these innate tendencies that are driving you to incorrect decisions. And now that I don't want that to scare anyone off, because I think that there's a way around this, which I'm going to share in just a second. But for example, one of the most common one is confirmation bias. The tendency to overweight, seek out, or more readily recall information in a way that confirms your preconceived beliefs, while simultaneously undervaluing or ignoring information that disproves our preconceived beliefs. Basically, you're going to look for stuff that confirms what you think you want to think, and you're going to ignore stuff that proves you wrong. You're going to confirm what you think, and you're more biased towards information that confirms that. So again, think about making an investment decision. You're looking at a stock, you think, great things are happening on the chart, and then you hear some really bad stories. You look up the seasonality charts, you start maybe looking at the intraday charts, and there's some ugly things happening, but you really want to buy the stock. And so you're going to look for information that confirms, yes, this is a great trade. And you're going to simultaneously ignore stuff that says, hang on, maybe this isn't really what you want to be buying. So I'm going to direct you here in just a second to a chart school article, but why does this matter? These understanding these cognitive biases, they matter because the first step towards combating them, overcoming these effects, is just understanding them. If you understand that they're there, you've got them sort of in the back of your mind. Hey, am I falling victim to confirmation bias or the endowment effect? That's how you combat them. And again, their relevance to investing is profound. So what I want you to do is a little bit of homework here. Go read this article in Chart School. It's totally free. It's called Cognitive Biases. You can search the site for it. I actually wrote it a couple of years ago. But it's a great article that'll walk you through a lot of these cognitive biases and specifically the ones that are most relevant to investing. So I'd encourage you to go take a look at that. Lesson 5 here, I'm going to keep flying. Discipline. Impulsiveness is deadly to your financial well-being. I talk to a lot of people and you say, what's your investing system? And they say, well, my interest kind of comes and goes and I kind of just make decisions kind of haphazardly when my interest is at a high, and then I lose interest, I kind of ignore stuff, but I still own it. That's horrible. If you're making impulsive decisions, that is deadly. Your investing system is only as strong as your discipline to stick to it. You can have the world's greatest trading system. You can have the greatest rules, the best technical indicators. You can be set up for the right signals. But if you don't have the discipline to stick to that system, it doesn't matter. It doesn't matter how smart you are, how clever you are. Nothing matters if you don't have the discipline to stick to your investing system. I'm going to go out on a limb here. I've said this before in other presentations. I don't think that trading is that difficult. There's the dramatic pause there afterwards. With all of the tools, the resources, the educational resources, the commentary, the data, with everything that you have at your fingertips now, whether it's on your laptop or on your smartphone, all of the financial analysis tools that you have, I don't think that investing is that difficult. What it takes, though, is an incredible amount of discipline. So what makes trading so hard and what separates good traders, successful traders from not successful traders is discipline. Good traders have the discipline to stick to their system and execute it day in and day out, week in and week out. I think that is the difference. That's what makes investing hard, is maintaining the discipline and sort of having the emotional capacity to do this repeatedly over and over and over again. Routines and organization are how you execute discipline, how you maintain discipline. They're the key to consistency. And again, I've said this before with the system, it applies to routines as well. You need written routines. You have to write it down. A routine that's somewhere in the back of your head and it's kind of floating around, and it might change and you might forget it. And I got 5 routines, but I can't remember the fourth one. What was the fourth one again? That's just junk. You need to write down your routines. You need to stay organized. Organization is absolutely integral. Good organization, good routines, they're going to put both time and money in your pocket. I have daily, weekly, monthly, and annual, but daily, weekly, and monthly routines that are written down. They're in a checklist format. And for example, every Sunday, I have my weekly routines that I go through. I sit down Sunday evening. I'm getting ready for the trading week coming up. And I go through the exact same set of routines, and I literally check each one off. They're written down, and I am going through and I'm checking off those routines to make sure, yep, I'm going to do this. Yep, I'm going to do that. Oh, I forgot to do this. Okay, yep, I'm going to do that now. I'm going to check it off. Written routines are crucial. Lesson 7, it pays to be an optimist. Now, we might have some arguments about here, and if you're playing the short side of the market, that's fine. But for me personally, again, this is my investing system that I'm sharing with you today. Over the past 50 years, over the past 100 years, the optimists have outperformed the pessimists. Now, it depends on the time frame that you're looking at, but why? It's because the long-term trend of financial markets is up. I personally play the long side of the market. I do not play the short side. I don't short things. Because in my opinion, investing with a positive attitude, going to bed at night saying, yeah, I really hope that Netflix continues to grow. I hope their subscriber numbers go up. That'd be great. Investing with a positive attitude like that is more fulfilling to me than investing with a negative one. I don't like going to bed saying, I hope that company fails and a bunch of people lose their jobs, because then my short position is going to go up. If you're comfortable with that, if you like that, more power to you. Personally, I like to put the long-term trend of the market on my side and play the long side. Again, I said this earlier. I love this quote from Arthur. Expect trends to continue, not reverse. Really, at the end of the day, that defines my investing strategy. Simple systems that take advantage of trend and trends continuing. So again, look at 100 years of the Dow. It's up and to the right. The chart is up and to the right. Look at some of the crashes. I mean, this is a chart of 2 of the biggest crashes that we've had recently, and the market has recovered from both of them. So I like to put that long-term trend on my side and play the long side. I'm getting close to the end here. Ask what, not why. No one is paying you extra to answer the why. And I love to use the crash actually of 07, 08, 09. The market rewards investors who know what and pull the trigger, not those who ask why and they sit around and they're waiting on the sidelines until they find an answer. You take 2007, 2008, 2009, the complexities of the housing crisis and everything that was going on with the derivative products and everything, that took months, years, a decade maybe. I mean, I was studying in college and we were kind of still just starting to figure it out in 2014. That took so much time to figure out. And so everyone who was sitting around saying, wait, hang on, why is the market crashing? I'm not sure, the market's been going up for a while. I'm not sure why this is happening. I want to figure out why before I sell any of my positions. Bad strategy. What was happening in 07, 08, 09? The market was crashing. You pull the trigger, you get out, you ask why later. The why often takes months, years, decades to figure out. Again, look at these bear markets. What was happening here was the trend changed. It started going down and the market was crashing. Get out, pull the trigger, act on the what, ask why later. Lesson 9, analysis paralysis. I wrote a blog, again, a little piece of homework here. I wrote a blog last week. It's kind of funny. I was getting messages from Julia saying, oh my God, that blog was awesome. You guys, that was so great. I really enjoyed your blog. Go read this blog. I'll put it up here in just a second. But analysis paralysis, no matter how much research you do, you're never going to have 100% of the information. So many people are absolutely crippled by this fear of not having complete information. They're crippled by analysis paralysis. They're paralyzed by this ongoing, endless analysis, and they never pull the trigger. They never make a decision. They never act. On both the buy and the sell sides, if you're not acting, that's still a decision. Inaction is still a decision. A lot of people think, oh, if I don't take any action, that's or if I do take action, that's a decision. And if I just sit here and I kind of ignore it, I'm not making a decision. That's fine. Inaction is still a decision. You're choosing not to do anything. There's a great sort of insight that came out of Amazon. I think it was about a year ago. They said they, as an organization, they try to make decisions when they have 70% of the information available. That's a Bezos thing, a Bezosism. If you have 70% of the information available to you, you have enough to make a decision. You have to act, you have to go, you have to take a little bit of a leap of faith, and you have to do something. Again, here's that blog. It's from last week in the Traders Journal. You can go to stockcharts.com/journal. It'll send you over to the blog, but it's called Stop, Don't Touch It, Let It Go, Quit Tinkering. I get this a lot. The first thing that people ask is, hey, but what if you just change this, you modify that, you try it this way, maybe if you do this. No. I don't do that. I've got a system. I let it send me signals. I act on those signals. If they go the right way, great. I let those positions run. If they go the wrong way, that's fine. I learned a lesson and I get out. Simple. Last lesson, buy strength. Again, this is kind of, building off of that idea of the long-term trend of the market, but catching a falling knife is nearly impossible. It's very, very, very difficult. And I'm tempted by it all the time. For example, Tom and I had arguments I guess it was a couple of years ago now, but about Chipotle. Is this the bottom in Chipotle? And that thing just kept falling. It would rally a little bit and it would fall back down. Rally a little bit and it would fall back down. Catching a falling knife is incredibly difficult. And like I said, I'm tempted by it all the time. But because I have this sort of rule in place, I steer clear of that. I'm trying to buy strength. I'm trying to buy growing companies that have strong trends, and I just try to ride that trend until it turns. The benefit of being an individual investor is that I'm never going to move the market, specifically when I'm buying mid-cap and large-cap stocks. I'm not a hedge fund. I never have positions that I have to carefully unload. I don't have to disclose anything. It's easy. If a trend changes and I'm holding the stock, I just sell the position. I get out. That's a benefit of being an individual investor. You're not going to move the market, so I can move very, very, very quickly. And that is a huge, huge difference between big institutional campaigns, big institutions, and the little guys like us. It's a tremendous advantage that we have. So again, don't discount leadership because you're too scared to be late to the party. I mean, I started watching NVIDIA when it was at $30. I haven't even looked at a chart of NVIDIA in a couple of weeks, but we're well over 200. We're up towards 300 on NVIDIA. And at $30, I remember looking at it saying, wow, this thing has run pretty far. And a lot of people were saying, it's gone too far, too fast. Don't discount leadership. Leadership and growing companies are growing for a reason, and they're leading for a reason. Don't be too scared to be late to the party. Key takeaways. We've got the 10 lessons in place now. Key takeaways. Find your edge and build your system. If you walk away with one thing from today, that's what I want you to leave with. Find your edge. Build your system. Again, be the business that you'd want to buy. Treat your investing, take it seriously, treat it with the seriousness that it deserves, and act like the business that you would want to buy. Get to know yourself. Understand those cognitive biases that we talked about. Go read that article. Take some time to just be brutally honest with yourself and say, what am I good at? What am I bad at? How do those affect me in the market? Lastly, ask what, take action, and get moving. Go out there and learn. If you take a loss, I've said this a lot in past seminars and courses and things like that. If you take a loss and you learn a lesson from that, all you've done is paid tuition to the market. You've paid tuition to the market to teach you something. And if you extract that lesson, you learn from it, and you apply it in the future, and you don't make that mistake again, then that's fine. You pay to go to college, you pay the market to teach you some lessons. If you take a loss and you ignore it and you just say, that was terrible, I made the right decision, but something else happened, then it becomes truly a loss. Ask what, take action, get moving, go learn something. Go learn about yourself, go learn about the market, get moving. Lastly, I got my book up here. If any of this kind of resonates with you, I would encourage you to go buy the book. I think you'll enjoy it. And you can also visit our website there at Stock Market Mastery. I think, if you join our mailing list, we've got an online course that we're hoping to develop in the next couple of months. So we'll keep you informed on that. But other than that, thanks for having me, guys.
Really fun. Grayson, that was a great presentation. And I know there are a lot of questions in the chat room, so I think Aaron's going to summarize a couple of questions for you.
Sure.
And
I know I went long, so let's hit those quick.
Yeah, no problem. One of the big ones, of course, is do you have a scan that you use for that Fantastic Four that you talked about earlier?
You know, I don't. One thing that I do have is alerts set up for specific scooter levels. So I actually have a scooter crosses 80, scooter crosses 85, scooter crosses 90, and scooter crosses 98 for large cap and mid cap groups. And I get those alerts every day. They get sent to me every day, so I get to kind of watch the scooter lists. The tool that I use instead of scans for that sort of Fantastic Four thing, I use the sector summary. Tom has done a fantastic job. You're always showcasing that thing. If you look back at, like, let's say 3 months or maybe 1 month, depending on your time frame, or longer, and you start with the sectors, you take one of the top 2, you click into that, you take one of the top couple industry groups from that sector, you click into that, then you sort it by scooter. Maybe look at whatever group you want to look at if you're primarily looking at large cap or mid cap or something like that, and then you click on the stock that's leading, sort of drilling down into the sector summary thing. It's incredible. You'll find those Fantastic Four charts. So that's kind of how I do it, actually. I don't use a scan. I just use the sector summary page. It works pretty much just as well.
All right. And your chart style, is that available if they go into the blog? Would they be able to copy a chart to get some of the chart styles that you use with those moving averages?
Yeah, you should be able to. There is actually the Grayson Roze chart style, which has, if you want to go and grab your if you're a Stock Charts member and you want to go grab the Fantastic Four charts, you can do that from the Grayson Roze chart style. I think I might have to go upstairs here in a minute and say, Chip, I need a chart style in the workbench.
Yes, I think you do.
Great presentation. I know you did a lot of homework putting all this together for everybody, Grayson. I really appreciate it. Really some super lessons for everybody, certainly as they look at their own investing strategies.
Yeah.
I would just say I've also told people I think it's a good idea to write things down, and you really stress that a number of times because you don't really get the sense of whether or not you're following your system unless you really go back and write it down and check it out.
Yeah, absolutely. All right, guys, take care.
You've got a problem. Your investments aren't growing as fast as you'd like. So you did a smart thing. You opened an online brokerage account and started learning more about the financial markets. But now you have a bunch of new questions, like, which stocks should I buy? When should I buy them? When should I sell them? You tried watching the talking heads on the financial channels, but they just gave you untimely advice that the real pros already knew about. It's all starting to feel a bit too little, too late. But what if there was a way to know, to truly know, what the market was thinking and how it was behaving, even before the pros? What if you could learn where the market was headed while there was still time to profit from that knowledge? With StockCharts.com, you can. Trusted by thousands of online investors, StockCharts.com has the charting tools and analysis resources you need to make smarter investing decisions. Our intuitive web-based tools make it easy to create high-quality financial charts in just a few simple clicks. Save and organize the charts you're watching to make managing your portfolio a breeze. And when it comes time to buy, our unique technical ranking system sifts through the markets and quickly points you to the most promising stocks and funds. You had a problem until you found the solution at StockCharts.com. Start your free 1-month trial today and see what superior financial charting can do for you. StockCharts.com, simply the web's best financial charts.
So in the book itself, just so everybody knows, it's all stock charts charts. It's all stock charts setups. But I talk about why to use candlestick charts, why you might want to use line charts, bar charts, mountain charts like you'd see on the business news networks and those kind of channels. A lot of it is about the settings in stock charts and how to make great charts. This is actually a book about building your base, understanding how to make the chart display the information you want, all of the little trick settings. I think it came out pretty well. So in the book, what I try to do is show how to get things set up, specifically about overlays and indicators, how to turn them on, how to change the settings, how to make them show up the way you want them to. And so if you're struggling with any of the sort of chart settings, that's an important part. With that, thanks everybody.